continuing to move through the accounting information system. So we started analyzing the business transactions. We've journalized the transactions. Now we're going to talk about posting to the ledger accounts. Eventually we'll move on to the trial balance. In later chapters, talk about adjusting entries in the adjusted trial balance. Eventually make the financial statements, engage in closing entries, and the post-closing trial balance. We're going to talk about the ledger. The ledger is comprised of an entire group of accounts that are maintained by the company. So you will have ledger accounts for all accounts that you have. So for example, assets. Common asset ledger accounts are equipment, land, supplies, the cash accounts, liabilities or obligations, common accounts, interest payable, salaries and wages payable, accounts payable, notes payable, stockholders' equity accounts, salaries and wages expenses, service revenue, dividends, retained earnings, and common stock. Bearing in mind, of course, that all income or revenue accounts and expense accounts ultimately impact the stockholders' equity account through their interaction with retained earnings. The accounts that we use are going to be listed in what's called the chart of accounts. This is a very small chart of accounts, and as you can see, there's only a few accounts that are listed for each for Sierra at this time. This is a list of the accounts that the company uses, the account titles. Remember, those are what we're using in our actual journal entries. They're going to be listed most often in the order of assets, liabilities, stockholders' equities, revenues, and expenses. So one of the things to keep in mind as you move forward in perhaps a position in accounting is that sometimes these accounts actually have numbers attached to them. Usually when there is a numbering sequence attached, you're going to find that if the number begins with a number 1, whether that is 100 or 1,000, 100,000, if the first number in the number is a 1, that is usually indicative of an asset account. If it begins with a number 2, that's a liability account. And number 3 is a stockholders' equity account. Number 4 is a revenue account. And number 5 is an expense account usually. Posting is the process of transferring journal entries, so what we put in the actual general journal, to the ledger accounts. Posting accumulates the effects of these journal entries into the individual ledger accounts, and it contains 3 steps. So as you see in the ledger, we enter in the appropriate columns the information that is coming over from the general journal. In this case, we have a date, so October 1st. We're looking at the general ledger for cash, so we look at that specific line. We'll look at what the transaction description is, and that transaction description for that entry is to issue stock. There is a reference number, and what that ties back to when we enter a reference number here is what page of the general journal is this actual entry on. Helps you get back to the general journal if you need to do some research. And then we transfer from debit to debit to show what was done to that specific entry. Now last, but certainly not least, we go back to the original entry in the general journal and we populate on it the account number that this was posted to. So for a quick review question, posting, which one of these 4 situations describes posting. Does posting normally occur before journalizing? Does posting transfer ledger transaction data to the journal? Is posting an optional step in the recording process? Or does posting transfer journal entries to ledger accounts? It transfers journal entries to ledger accounts. So now that we have shown you the entire basic process that leads up to posting, let's just kind of real quick look at an illustration, because this shows everything for a transaction, all the way from basic analysis to posting. Remember, first we have to determine what types of accounts are involved, what is going to be changing in economic value as a result of the transaction. Is this actually a transaction? Is it something that is recordable? October 1st, stockholders invested $10,000 in cash in an outdoor guide service company to be known as Sierra Corp. So we know that the stockholders invested $10,000 in cash in Sierra Corp. So Sierra Corp received $10,000 worth of cash. The asset cash is increasing. So there has been a transaction. They did this as an investment, and it is the stockholders. So we know that some element of stockholders' equity, in this case common stock, is going to increase by the same amount. Because we haven't been given any other information to indicate that it's another type of stock, or that any of this needs to be split in some other fashion. We sit down with the accounting equation to determine what items increased or decreased and by how much. If we take assets equals liabilities plus stockholders' equity, cash went up $10,000, and the amount that was invested, the representation and ownership, increases by $10,000. We translate the increases and the decreases into whether they are an actual debit or credit. Because remember, whether something is a debit and is an increase, or is a credit or an increase, depends upon the account type. Debits are the means in which we increase assets, going back to the hand gesture. Remember, assets, liabilities, revenues, stockholders' equities, and expenses represent the 5 fingers. And when you hold it in that position, the 2 fingers that are up increase through debits. That's expenses and assets. All other normal accounts represented by the other fingers will increase with credits. Stockholders' equity is a credit, and in order is a credit finger, and we're increasing it by $10,000. We then create the journal entry itself. With journal entries, remember your date. Your first lines will represent your debit lines. Be sure to enter into the correct column, debit being left. Your second line, indented, will represent your credit accounts, the lines that will represent the credits of this transaction. So we will move that over to the right to the credit column. We then have just a short descriptive note. That short descriptive note, remember, when we go over and we do the actual posting to the ledger accounts, is the part that goes over there. We take this data that we created with the journal entry, and we translate it over to posting. Each of these slides shows a little bit about each of the economic events we looked at this chapter. Now you'll notice the cumulative effect here in cash that has occurred across all these different pieces of the chapter. Remember, what we will do is we will add up each side. Whichever side is higher is the side of the balance. We then take the higher side and reduce it by the lower side, and that will tell us what the actual balance is in the account at any given point in time. So here we have just an illustrative summary of the collection of general journal entries and what they would look like. I'll pause on each of these next slides for a second so you can look at that, but you can always hit pause in the video to take a closer look yourself. Now here we have a T account illustration of all the accounts in the general ledger. Cash, supplies, prepaid insurance, equipment, notes payable, accounts payable, unearned service revenue, common stock, dividends, service revenue, salaries and wages expenses, and rent expense. We'll take just a second to work on the do it. In regards to posting, for Fatal, I'm going to go with Fatal Incorporated during its first month of operations. They want us to post these transactions to the T accounts. So on July 1st, we received $30,000 worth of cash in exchange for $30,000 worth of common stock, it looks like. So we enter on July 1st, the left-hand side of the T account, $30,000. That's the debit side. Left is debit, right is credit. We then post to the right-hand side of the common stock T account, because this is a credit amount right here, $30,000 with the date indicator. On July 9th, we have a $6,000 increase to our accounts receivable and a $6,000 increase to service revenue. This means that we provided services worth $6,000 to a customer, and they will pay us in the future. On the left-hand side of accounts receivable, we enter the date and $6,000. And the right-hand side, that was the left-hand side of accounts receivable, my apologies. On the right-hand side of service revenue, we enter the date and $6,000. And then we receive $4,000 from a client for services that we rendered at a prior period in time and that we have billed them for. So on the left-hand side, we'll put the date and $4,000 in cash. And on the right-hand side of accounts receivable, we'll put the date and cash. So at this exact point in time, looking at the cumulative effect in the ledger accounts, cash has a normal balance of a debit of $34,000. Accounts receivable, though, has had accumulation of impacts that both increase and decrease that account through the course of this month. They have $6,000 in debit and they have $4,000 in credit. That means that because there is a greater amount in debit, it has a debit balance. And the difference between the $6,000 and the $4,000 is $2,000. So it has a $2,000 debit balance.